Hi, and welcome to this week's Money and Markets Squawk Call, where we go around the horn with all of our editors to give you their insights on the happenings in markets for this week and beyond. Today is Tuesday, June 3rd, and joining us on today's call are Mike Larson, MANDEEP, Larry EDELSON, Doug Davenport, and Larry McMillan. Basically, the markets, obviously, as we've seen from stocks, U.S. stocks set new record highs. The S&P last Friday, the Dow again yesterday. The interesting thing I'm noticing, just looking at the different indexes, though, is a diminishing breadth in terms of market advances. If you look at the Russell 2000, for example, it's still well off of its highs, about 4 or 5% below its highs. As a matter of fact, the Nasdaq Composite, kind of same story with the wider breadth of thousands of issues, mostly smaller tech stocks than the Nasdaq. You notice that currently only about 3% of all the Nasdaq stocks have made recent new 12-week highs. The story is kind of the same for the Russell, even though the S&P 500 has got good breadth. About 70 or so % of all stocks are making new highs. It seems to me like the broad market isn't really participating in that. So I thought maybe we could discuss that a little bit for those of you that follow the stock market pretty closely. Also, it's a pretty busy week in terms of announcements. We have the ECB meeting coming up towards the end of the week, and of course a jobs report on Friday. So with that said, Mike Larson, why don't we start off with you and your observations on the market?
Sure. Good morning, everybody. My biggest observation on the market is simply that there's not a heck of a lot going on, and that's why I'm particularly worried about the markets at a rate that I haven't been in a long time. By nothing going on, I mean a lack of volatility. Everybody focuses on the VIX, the CBOE options gauge for stocks, and it's true the VIX has been falling steadily. I mean, we got as low as 11.3 roughly yesterday, which is essentially the lowest the VIX. I mean, you can argue about a couple of points here, whatever. It's essentially the lowest this indicator of stock market volatility has been since the late 2006, early 2007 period, which was the peak of the last credit bubble and right before the markets blew up. If you go past that, you have to find an equally or the next lowest period for the VIX. It was kind of in the late 1990s, right before the stock market blew up. If you look at bond volatility, something called the MOVE index, which is kind of the VIX equivalent for Treasury bonds, it's at the lowest levels of volatility since, you guessed it, 2006, 2007, right before the market blew up. If you go further back before that, when was the last time it was so low? 1998, 1999, right before the market blew up. I mean, you're probably sensing a pattern here, but basically,
yeah, not a very good one.
If you're looking at the euro currency and volatility, when was it the last time that the U.S. dollar euro currency pair was as unvolatile or placid as it's been? That was basically 1999, right after the euro was rolled out and right before the markets blew up. You can go right down the line. You can look at junk bond yields at absolute levels or spread levels. They're basically either the lowest ever or right around the lowest in 2007. Across the board, the volatility has been completely sucked out of all markets. Which sounds good, I guess, from a typical standpoint. I mean, don't you want the markets to be calm and steady and it's just steadily climbing? But the problem is, paradoxically, periods of extremely low volatility breed periods of extremely high volatility. There's too much complacency. Nobody's buying protection. Everybody's all in the pool on the assumption that easy money is going to prop everything up. And when you have everybody leaning one way, that makes you vulnerable to a sharp zag the other. So, I mean, it doesn't mean you go out and short everything willy-nilly, but I've been looking at reducing some exposure in the Safe Money report, dialing down a little bit of risk, taking some stuff off the table with big profits. And moving up to the quality scale in terms of jumping a little bit riskier stuff. And I mean, not that anything in Safe Money is risky by its own name, but looking to move into some more kind of stable stocks, your foods and things like that. And dialing down a little bit of economic exposure. And the interest rate. What's very interesting, if you'll pardon the pun, is that we've been in a market lately where markets are moving all in one form in terms of price appreciation versus the opposite direction. I mean, typically when you see bond prices rise and yields fall, that's because stocks are declining. But what we've seen in the last several weeks is that bond prices have gone up right alongside right alongside stock prices. Yet in the last 3 or 4 days, that's begun to change. The bond markets got whacked fairly hard. I mean, we're not talking about a huge difference in the longer scheme of things. But, we've lost about 2.5, 3 points in the bond futures from the spike high they had the other day. And we've seen the euro currency after a big rally decline to about a 3.5-month low. And all of these, to me, tell me that I think we might be in for some turmoil here as we head into the summer. So again, I'm getting a little more defensively, a little shorter than I've been in quite some time, both in bonds and stocks, because I think if volatility explodes, if bonds and stocks could go up at the same time, then a rise in volatility and something that shocks the market suggests that both bonds and stocks could go down at the same time. So that's kind of how I see things. Return of volatility after a period of immense complacency.
Yeah, indeed. We have seen just yesterday and the early futures this morning. We see both stock futures and bond futures have been off a little bit the last 2 days. So you may be right. Let's see. How about MANDEEP? What do you think, MANDEEP? Are all these signs of complacency in the various VIX and other sentiment indexes a sign of trouble for the markets?
Hey, good morning, everybody. Yes, and I generally agree. The markets are telling you, there's a divergence there. You see the American Association of Individual Investors are more neutral than they've been historically compared to historical averages. The numbers are about 10 percentage points higher than they normally were. And they're not necessarily going into bearish. They're just moving out of the bullish camp, and they're saying, hey, let's step back a minute here. We've had the markets rally. Let's take gains, move to cash, move to defensive names. Let's reassess what's going on in the economy. We've had a declining GDP print for the first quarter. Second quarter GDP doesn't come out until the end of July. The advanced numbers there. The readings are all over the scale, all over the map at this point. You have between 2.5 to sometimes in higher as 4+% growth. So without some more clarity in what those numbers are going to look like, despite having leading indicators pointing to better numbers, like the permits numbers, new orders, ISMs, sentiment, and claims, those leading indicators are generally positive. With such a spectrum of what the numbers could be in terms of future growth, you're not very confident in being long equities without some sort of clarity, especially with the rate tapering is coming to an end, liquidity is going to come to an end, and rate hikes are in the future. So if you look at what's working year to date, utilities 13% higher. That's kind of concerning. I mean, if you see S&P is up 5%. And it's not up straight 5%. It's been all over the map. Well, actually, S&P has been relatively more stable compared to the growth names, the Russell, the tech names, and the Nasdaq. There's been a lot of pain in those indexes, especially some of the individual names. Discretionary names, the S&P discretionary index is down 1.2% year to date. So with that said, in the last call, everybody said. Most of the editors here were saying that to be cautious, and it was good advice. You're still seeing the same things. Yesterday, you had the S&P and the Dow reach all-time highs on an intraday basis, and then you had the Russell and the Nasdaq were actually down on the day. That kind of divergence is still continuing, and you have folks that come in when the markets are showing some signs of strength. Some folks will come in, but what are they buying? They're buying those defensive names, the increasing dividend, staple type companies that are more bond-like in their payouts. The question is, how long is this divergence going to last? And we don't really see an end to it anytime soon. We need to see growth. We need to see production growth, and that's not going to come out until the end of July. And as Mike was saying, complacency is probably the operative word here, because folks are you're neutral, but you're not really buying protection. When you have these kinds of historical lows in complacency, it's usually followed by something big. So we remain cautious. We like quality over growth. We're not paying for 2016, 2015 plus, earnings. We are looking for dividends. We're looking for proven names. We're looking for historical performance, and we're also keeping a large cash buffer to stay cautious. And that's the way we're playing it right now.
Okay, thanks for those insights, Mandeep. Very interesting. And indeed, you're right, this divergence has got to play itself out at some point. Usually it does end badly, so we'll see, we will wait and see. Larry Edelson, I see you're on the call. Of course, you've been calling for a bit of a correction in the stock market for a while, and I've noticed recently commodities have turned a little bit weak, perhaps on a global growth scare here after the GDP print in the U.S. What are your take on those two markets?
Well, yeah, equities. I agree with the complacency issue. That's a major problem for equities right now. I agree 100% with Mike and everybody else on that. The equity market is in a long-term bull market that's going to go substantially higher, 28, 30, 32,000 over the next 3 years. But it's got to first pull back, and it's going to be driven by capital flows on the upside. But right now, it's just overdone on the upside, and it's got to take a breather. I'm shorting the S&P probably this morning. I think we saw the top at 24.75 or 24 and a quarter on the S&P, 1924 and a quarter, and we've got some downside to about 1800, maybe 1770. Not a lot. I'm not expecting any bear market. I'm not expecting any crash. From there, we'll take off again to the upside and to new record highs probably by the end of the year. Gold and silver have one more leg down, but they are definitely bottoming. I think gold can get down to 1226, silver can get down just below $18, and we'll have a new low for the 3-year bear market for silver. I don't think we're going to see a new low below 1180 in gold. The spread there is widening for monetary reasons. Gold's definitely performing a lot better than silver. The ratio is out to 65 to 1 roughly. From 51 last November, which tells you that people are moving, to the safer precious metal, which is gold. And the mining shares are bottomed. I'm putting out a recommendation today to get into one particular mining share, and I'll be an aggressive buyer over the next several months of many different mining shares.
Okay, thanks for those thoughts on the market. Let's see, Doug Davenport, you're of course a very close follower of the trends in multiple markets. What's your take on the recent complacency and divergences we've seen in stocks?
Well, it's an interesting topic. You look this morning at people are buying volatility this morning. You can look at 9 ETFs that are up over 0.5% this morning in pre-market, and these all are, you've got like the financial bear 3 times, 3-time financial up today in pre-market. You've got the daily gold miners 3 times up. You've got ProShares Ultra Short S&P 500 up. You've got ProShares Ultra Short, another one. You've got TBT up. You've got TZA up, the directional small cap bear. So you've got 9 volatility type of ETFs up over 0.5% already this morning. So there is some volatility buying this today. But I tend to look more intermediate to long term. But on the short term, we've got to see how the S&P handles itself at this key wedge line resistance that it's bumping up against right now. And can it acquire its next target of 1928? Now, last week I gave 3 targets out. The first was 1903, which was acquired. And now we have 1928, and we need to see if that can be acquired this week. And then we have an inverse head and shoulder pattern that measures out to 1980. How long that may take, but that pattern is there, and we'll see if it ever acquires that this summer. Now, we need to acquire this 1928 target because that reduces the risk of a bull trap reversal that we saw back from March to May, where we had 3 of those where the market stuck its nose up above resistance and then quickly pulled back. So we need to make sure that this thing can stay and hit 1928 so we don't have a pullback. And, of course, we can have a pullback in the S&P because right now on the daily chart it's up at the very top limit of its Bollinger Band. But we've seen sustained and significant price action improvement for the last couple of weeks, and we need to see this follow through to have a positive development for the market. But obviously we all know you're going to have to see some significant improvement in the NASDAQ and the Russell above its prior highs back in March to avoid any potential really major top forming this summer in the market. Now, in the euro, ECB is expected to cut its deposit rate this week, putting it in negative territory for the first time ever. Potentially, they may take other steps to stimulate the eurozone. Been a lot of dovish talk out of Draghi, and he better have some bold action this week, or the euro is going to bounce back up quicker than you can say. Euro, because even today it's up almost 0.4%. I got about a 1.365 as resistance right now in the euro. Downside, I only see about 134. It's a narrow range, but there better be some strong action, or the euro is going to bounce back up. In my opinion, it's just the way the markets work. Fed's got some large buy programs out today, and even a larger buy program on Thursday. So we have cash coming in today and Thursday. Gold, only two words for that asset class, bear market. Oil had its first weekly loss in 5 weeks last week. Appears to be forming a triple top around $105 a barrel. Resistance is about 105. If it breaks that, it'll go up, as I mentioned last week, maybe on the amount of oil being bought by China, as I mentioned. Support down about 91.50. Could easily run down there if it breaks below 100. What's interesting right now, two equity sectors that I use in one of my portfolios are basic materials and energy, and those have been two of the best performing sectors this year. And what's interesting is you can go back and take a chart and look at 2007, look at the sectors of the market from January through May year to date, and you'll find that the top two leading sectors in the first 5 months of 2007, what were they? Energy and basic materials. Well, the reason for that is that those are classic late cycle behavior by those two, because energy was up 14.5% in the first 5 months of 2007, and basic materials was up 14%. So we're kind of seeing the same kind of performance right now, classic late cycle behavior. So take it for what it's worth. Emerging markets, trend is up, had a low in February. We've had strong performance. It was up almost 3% in May. If you look at the EEM, which is what I use, you've got Taiwan and Korea, the number 2 and 3 countries in that particular ETF. South Korea just made a new 3-year high. Nice move there in that market. Taiwan also now has already exceeded its 2007 and its 2011 high. So it's doing well, and that's keeping the emerging markets doing well, or EEM, I should say. TLT, still long TLTs. As of last Friday, over 13% year-to-date return. You've got pension funds out there so hungry for yield, they're buying anything they can find out there. Worldwide, European sovereign bonds, corporate junk, preferred stocks, it doesn't matter, they won't yield. German 10 years at 1.36, we're at 2.5 plus, kind of interesting. And you remember we talked about the amount of bonds being bought out of the country of Belgium or Brussels last week or 2 weeks before, but a little research, I thought that might have been China buying it, but from some people that I've talked to this week, hedge fund managers, they seem to think that buying of our bonds by that large amount in Central Europe or in Brussels was basically the ECB probably buying bonds. For lack of anything else, if I had to make a guess, I'm going to bet that Fed's going to have to hit the pause button sometime this year. Growth is just GDP growth and growth in the economy for the consumer. It's all slowing. I don't see how the Fed can continue without hitting the pause button and renaming some sort of new program going forward. Of course, opinions are worth what they are, not much, but I just bet that will end up happening this year, but that makes no determination of how I manage money. But I just think that with the growth slowing, you're going to have to see the Fed slow down. And I think interest rates are going to be low for quite a long time.
Doug, do you expect the Fed might actually ease up on the tapering, or actually fully reverse course and start to print money again with a new QE program?
Could easily do both. They may call it something else. I think they would have to call it something else, and they may use some new type of program that would achieve the same result, but just not continue to buy mortgage backs and treasuries. I don't know what that would be, but there's a hedge fund association I mentioned here in Atlanta. We had our monthly meeting last night, and they had a vote to find out what people thought. It was about 35 members, and the overwhelming majority felt like the Fed would pause at some point. But what would be the new program that comes about? No one really knows.
And since you're a betting man, how about the ECB that meets this week? Are they going to launch a QE program of their own? in your opinion?
I don't know if they'll launch a QE program. Everyone seems to be betting on it, and that's why the euro's fallen. Draghi has obviously gotten what he wants by talking this thing down. But in 2012, he said that he would do whatever it takes. Now he's got to come up with some action, or the euro's going to bounce back up, in my opinion.
Okay. Well, thanks for those insights. Very interesting.
Sure.
Let's see. We have one more guest who's a wireless caller, so I'm not sure. Is that Larry McMillan?
Well, basically we're trend followers, and we're trying to show up, and obviously you're overbought, but either a number of ways you want to look at it. One is market breadth is expanded, which is that's fine on a breakout, but we have had a couple of overbought levels there. What I'm not seeing though, I'm not seeing the put-call ratios get overbought. They're on buy signals, but they're not at extremes yet. So there's I wouldn't say euphoria amongst call buyers has not been reached yet, so that's a positive sign. Obviously, the 1900 level on SPX, S&P 500 is important to us in terms of the trend, but really, trend would even still be up as long as 1860 is not broken. The big thing is, volatility, and we were just doing some studies and putting together something probably for next week's newsletter, but the VIX hit 11 in early 2005, and really the market pretty much went up for 2 more years after that. There was a halfway decent correction in the middle of 2006, only minor corrections in 2005. So, I'm not saying that the market's going to go for another 2 years. VIX hasn't even gotten all the way down to 11 yet this time. But just because VIX was low doesn't, really mean the market's ready to break. And it's the old Keynesian thing, the market can stay overbought longer than you can remain solvent. Speaking of short sellers in that case, I guess. So we're basically thinking that the market can continue to rise as long as VIX doesn't break out above 14. But VIX doesn't break out above 14, then I think the trend of things will probably be changing. So other than that, pretty much status quo, staying on the long side and trying to follow the trend.
Okay, well, we'll certainly keep a sharp eye on that VIX, which is seems to be sinking lower and lower, as Mike Larson pointed out. Well, that wraps things up here for this week's SQUAWK Call. Some great insights, gentlemen. Thank you very much, one and all. And also be sure to tune in again next week. Until then, I'm Mike Burdick from Money and Markets. Good investing.